July 26th, the announcement out of the Federal Reserve and why it's so important. I have all the details and what you need to know right here in the video, so let's get right into it. All right, now in this video, I specifically want to talk about July 26th and the big announcement coming out of the Federal Reserve, as well as what we can expect from this announcement, what the consensus is out there right now as far as what they're going to be announcing, and why this is so impactful for all of us right here in this community, as well as all across the country. Let's get into it and talk about all the details. However, really quickly before we do, thanks so much for joining me. If you're new here or if you haven't done so yet, please make sure to subscribe right down below the video. It's totally free to do so, and I'm here for you right by your side each and every day, watching the latest details hitting the wire, doing the research and breaking it all down into these short videos so you can stay posted on what's actually going on right now as things continue to change very rapidly. So again, thanks so much for joining me. Please subscribe down below if you haven't done so yet, and let's get into it and talk about July 26th, the Federal Reserve, their announcement, and what is going on, as well as the impacts and the consensus out there right now as far as what this announcement is likely going to be. Now, if you've been watching the videos here on the channel for any length of time now, you've heard me talk about the Federal Reserve many times before. Every 6 weeks, they are out with their next meeting, and this is the next one here on the table in a matter of just days that I want to break down for you, because this does impact all of us, even though we look at this and think, oh, it's just the Federal Reserve, just another economic data point. It doesn't really matter to me. It actually has a big impact on a lot of different things going on right now. All of us, the consumers, as well as the economy, and a whole variety of other impacts as well. So first off, let's talk about the consensus as far as what is likely going to be announced by the Federal Reserve. So here's what the consensus is. Now again, obviously, these are just estimates, as in, consensus. It's nothing solid as of right now, but this is what people are anticipating. They're anticipating the Federal Reserve to raise interest rates yet again, another 25 basis points. Now, remember last year, we saw multiple 50 basis point and 75 basis point rate hikes last year in 2022. So far this year, we've seen a few different rate hikes. We've seen a 50 basis point rate hike early, right away at the beginning of the year. We've seen a few 25 basis point rate hikes so far, and the consensus is yet again another 25 basis point rate hike. Now, we continue to see coming out of the Federal Reserve, many of these people within the Federal Reserve continue to say that inflation is still too high right now, and additional interest rate increases will need to be brought in to bring this inflation down. So this is the whole purpose behind them raising interest rates, is to basically decrease the appetite for borrowing money. That's the whole purpose behind it, right? Because in their view, in the view of the Federal Reserve, the economy is too hot. In other words, too much inflation in the economy. Too many people borrowing money, spending money, driving up prices, things like this. So as they continue to raise interest rates, basically what it does is it drives down the appetite for us consumers as well as businesses to borrow money and to spend money. If less people are spending money, that means less demand for products and services, therefore less price increases, right? It's a simple supply and demand equation, right? Simple economics 101, supply and demand. Less demand means equal or greater supply, therefore prices must come down, as in lowering inflation, okay? So this is the whole purpose behind this. Now, this has been going on for a very long time. Remember, 2 years ago, we started to see inflation ticking up pretty rapidly at that time. In fact, in the summer of 2021, 2 years ago already, we were starting to see inflation in the 4% range, right? Well, it's kind of back where we're at about now, right? We're still a little bit above that, but it's kind of where we are. So in 2 years' time, we've gone pretty much full circle. We went all the way up. We peaked out at 9.1% in June of last year, 2022. And here we are, basically a year later, here in July 2023, and we're kind of sitting around that same range. So kind of interesting, in a 2-year period of time, we went from about mid 4% up to 9.1%, and here we are again around that same, range again. So I don't know, kind of interesting how that whole thing plays out. But the fact is, we're still over twice as high as where the Federal Reserve wants inflation to be, at about 2 to 2.5% range. That is their benchmark. So as a result of this, we're continuously seeing the Federal Reserve coming out, raising interest rates, and that is the consensus going forward. Now, again, let me point out really quickly why this is important and why we probably want to watch what the Federal Reserve is doing. Now, here's the thing. If you are like most people out there right now, you probably are floating some kind of balance on a credit card. Now, maybe the balance is $20. Maybe it's $500. Maybe it's $5,000. Maybe it's $10,000. Maybe it's $20,000. Hopefully, it's not these big numbers. But for the fact of most people, the average American out there right now has like $7,000 in credit card debt. So, a lot of people have a lot of money in credit card debt. Well, as a result of this, guess what? Interest rates on credit cards are adjustable. The average interest rate on a credit card right now is over 20%. That's a lot of interest to be paying, okay? Let's put it this way. Just imagine yourself getting a 20% interest rate on a savings account. Would you be happy? I'd be super happy. That'd be a huge, huge return on your money. That'd be awesome. A lot of people would really enjoy that. So my point is, the reason I wanted to give that as a perspective is because here's the thing. A 20% interest rate on a credit card is crazy, crazy high. That is very high, right? Well, we do know in this country as well, we are well over $1 trillion of credit card debt in this country. Just credit card debt, we have over $1 trillion. In total consumer debt, over $17 trillion in consumer debt here in this country. That's just consumer debt. That's not government debt, nothing like that. That is just us debt. Auto loans, mortgages, credit card debt, all the debts across the board, student loan debt, $17+ trillion. It's a ton of money, right? Anyway, my point is a lot of this debt is adjustable, as in when the Federal Reserve raises or lowers interest rates. In other words, interest rates also go up and they go down. Unless you are somebody who is locked in on a fixed rate on some kind of loan, like for example, a fixed rate mortgage. Maybe you have a 30-year fixed rate mortgage. Well, that's not going to be impacted by this, if you're already locked in. However, if you're not locked in yet and you're looking to buy a place or you're looking to finance a car or refinance your house or whatever, take out student loans, float a balance on a credit card, get a home equity line of credit, a personal loan, anything like this, a lot of these are adjustable and very much impacted by the actions out of the Federal Reserve where they continuously raise interest rates, and that is all coming back to us, okay? So basically what this is doing, it's making it more expensive to borrow money. Exactly what the Federal Reserve wants. They want to make it more expensive to borrow money so less people are borrowing money. As a result of less borrowing money, that means less spending money. Less spending money means less driving up prices on goods and services in the economy, means less inflation, lowering inflation, right? It's been a very, very, very slow process. Even though the Federal Reserve has aggressively been raising interest rates, well, not so much as of recently, but last year, 2022, they aggressively raised interest rates, even 4 back-to-back 75 basis point rate hikes in the middle of the year last year. That is very aggressive. They have not done that before. So that is very aggressive raising interest rates. And the whole purpose behind it is to bring this inflation down. Well, we know it's been working a little bit, but inflation is still very, very high right now on a lot of things like food is still 10%, right? Food inflation, still 10%. That's crazy high, right? How about shelter? Still up about 7 to 7.5% on shelter, as in rents, shelter prices, okay? Still very expensive. So the point is, even though, yes, inflation has been coming down on some things, it's still very, very high right now, and the Federal Reserve completely recognizes that, and they want to bring this down even more. So they got a lot of work ahead of them, and they've made it very clear. The chairman of the Federal Reserve, Jerome Powell, has made it very clear in previous press conferences, it's going to be a bumpy ride. It's going to be painful. The economic impacts are going to be painful. It's going to be a tough time. It's going to be tough for a lot of people, but this is the situation, and this is basically their objective going forward. So we can anticipate another interest rate hike, probably another 25 basis points. But, again, too, is that really helping? I mean, is it really bringing it down fast enough? So, who knows? But the point is, this is going to be very important. Another thing I want to point out really quickly is after we get the announcement on July 26th. So as far as what they're going to be doing with the interest rate hikes. By the way, that'll be coming out at 2 p.m. East Coast time on the 26th. When we get that announcement, the initial announcement as far as interest rates, 30 minutes later, at 2:30 p.m., the chairman of the Federal Reserve, Jerome Powell, will be out with a press conference. This is where he takes questions, answers questions. He talks for about, half hour, 45 minutes, hour, something like that. He talks for a while, answers a bunch of questions, and then this is where we get a lot of our answers as far as what is the Federal Reserve really, really thinking right now. Again, very important stuff. So, Either way, this is the next FOMC meeting. After this, our next one comes in July. Or sorry, this is July. Yeah, sorry. The next one comes in September. Sorry, I'm losing track of where I am right now. Okay. Sorry about that. Anyway, the next one comes in September. So nothing in August when it comes down to FOMC meetings, but the next one will be in mid-September. And between now and then, we're going to be getting some very important inflationary reports, as in the CPI. We're going to be getting a couple job reports coming out. A lot of good data coming out between now and the next one in mid-September. So anyway, want to point this out for you. Another key factor we got to watch very closely. It's going to impact all of us. When they raise interest rates, it just pinches our wallets a little bit more. Thanks, Federal Reserve. We appreciate it, right? Just kidding, right? I'm being sarcastic, obviously. Anyway, hope this one helps you. Again, I will continue to watch everything closely. I'll bring you that announcement, and I'll bring you the information right away as we get it on that day, and let you know what goes on there as far as what the Federal Reserve is going to do, as also as far as what the remarks are going forward, as this is very important stuff. Anyway, please make sure to subscribe down below if you haven't done so yet. Share the video with your friends, family, social media, and go back and check out any of the other thousands upon thousands of videos here on the channel. Until next time, enjoy your day, take care, have a good one, and catch you again later.